Hey everyone, let's dive right into today's explainer and translate the highly technical, sometimes overwhelming mechanics of options contracts into actual digestible concepts you can use. Whether you're totally new to the options game or you've been trading a while, making that jump from just knowing the basic mechanics to actually surviving the market long term, well, it can be pretty daunting. But don't worry, we are breaking the whole thing down today. So, here is our roadmap for today. We're going to run through the basics of options, then hit calls, puts, and leverage. After that, we'll look at the hidden danger of time decay, the mechanics of exercise and assignment, position sizing, and finally, we'll wrap up with the golden rules for risk management. All right, Section 1, the basics of options. Let's start right at the absolute foundation. What exactly is an option anyway? At its absolute core, an option is really just a handshake. Think of it as a simple contractual agreement between exactly two parties. You've got the buyer on one side and the seller on the other. Now, that contract has some very specific rules attached to it. The big one to remember? A standard option represents exactly 100 shares of an underlying asset. That could be a stock, an ETF, an index, you name it. Just imagine being able to control 100 shares of some super expensive tech stock with just one single contract. It's an incredibly powerful tool. It also locks in an expiration date, which is usually the third Friday with a month, by the way, and a strict strike price. Moving on to Section 2, calls, puts, and leverage. Now that we've got a handle on what a contract actually is, let's see how this builds into the two main types of trades you'll be looking at. So the really crucial thing to grasp here is this kind of mirror image concept. A call is basically a bullish bet. It gives you the right to buy 100 shares at that specific strike price. A put, on the flip side, is a bearish bet. That one gives you the right to sell those 100 shares. You also get to decide which side of that handshake you actually want to be on. See, the buyer pays a premium up front to get a right. But the seller? They receive that premium, sure, but they take on a strict obligation to fulfill the contract if the buyer decides to exercise it. It's a completely different ballgame. Now, let's be real. The main reason people trade options in the first place is for the leverage. It allows you to control 100 shares for just a tiny fraction of what it would cost to buy the stock outright. But, and this is a massive but, this is absolutely a double-edged sword. Yeah, it magnifies your potential gains, but it can equally, and honestly pretty viciously, magnify your losses too. Which brings us to Section 3, the hidden danger, time decay. This right here is the first major dragon of the market that you're going to have to face. You really need to understand the concept of a wasting asset. Because these options have a strict expiration date on them, they literally bleed value every single day. Traders call this time decay, or theta. And get this, that bleeding, it doesn't stop. It continues right over the weekend when the market is totally closed. Crazy, right? Okay, time for a really sobering reality check. It's estimated that roughly 80 to 90% of options traders actually lose money over time. Even the SEC explicitly warns that trading options can result in a total 100% loss of your premium. So we urgently need to talk about how to survive this, so you don't just become another statistic in that 80%. All right, Section 4, mechanics, exercise, and assignment. Before we can start building your risk management fortress, we kind of need to understand exactly how these contracts close out in the real world. So if an option finishes in the money, meaning it has intrinsic value, the buyer will exercise their right, and the seller is then assigned their obligation. Now, if you're the seller, this assignment can happen literally at any time, and it requires a massive amount of capital. Why? Because suddenly, completely out of nowhere, you're on the hook to buy or sell 100 shares of that stock. Moving right along to Section 5, position sizing for survival. If you want to avoid completely blowing up your account when trades go sideways, and trust me, they will, we absolutely have to master the math here. The absolutely crucial mindset shift you need to make is to work backwards. Stop asking how much you can afford to buy. Instead, you need to ask yourself how much you can afford to lose. Let's say you have a $50,000 account, right? And you decide to risk exactly 2% per trade. Well, your absolute max loss is $1,000. So if your risk per contract is $100, that $1,000 of max loss dictates that you can buy exactly 10 contracts, period, never more than that. Finally, Section 6, rules for risk management. Okay, we are now ready to lay out the absolute non-negotiable rules from Pure Power Picks that actually separate the consistently profitable traders from, well, the statistics. First up, at the individual position level, you've got to size properly and use percentage-based stops, usually around 20 to 50%. Now, you might be wondering why percentage-based? Well, it's because traditional chart support levels often just fail in the highly volatile options market. I mean, options can gap wildly just based on implied volatility, even if the underlying stock price barely twitches. So set those stops at the exact moment of purchase, well before your emotions have a chance to get involved. Next, to slay that time decay dragon we talked about earlier, you really should be entering trades with about 30 to 45 days until expiration. This gives your thesis actual time to play out. And here's the golden rule. You must religiously exit or roll those trades at 21 days out. Seriously, never hold into those final 3 weeks because that is exactly when time decay aggressively, and I mean rapidly, accelerates right against you. Now zooming out to the big picture portfolio level. Never, ever have more than 10 to 15% of your total portfolio at risk at any one time. We call that your portfolio heat. Also, you got to make sure your trades aren't highly correlated. A really massive mistake I see traders make all the time is buying calls on Apple, Microsoft, and the QQQ, and genuinely thinking they're diversified. Actually, scratch that, it's more like a disaster waiting to happen. Those are highly correlated tech stocks, and if that sector takes a hit, they are all going to crash together. Finally, we have to talk about controlling your emotions. You need to track your performance meticulously. Never, ever average down on a losing option. Honestly, you're usually just buying more time decay when you do that. And please, take your profits systematically. Always remember, greed kills way more accounts than fear ever will. So what does this all mean? Options are an incredibly powerful yet notoriously unforgiving financial tool. To actually succeed here, you must stick to the math. You've got to cap your portfolio heat, and you need to treat every single trade as just one in a series of hundreds. So I'm going to leave you with this one thought. When you enter the market tomorrow, are you going to be gambling on pure luck? Or will you use these structural rules to become that rare trader who actually survives and thrives?